Hi, this is Kim Watson of Ezeetrader. Welcome to this week's midweek review. Now, the subject of this review is the one statistic that everyone should be aware of and adhere to. I didn't put that on the slide, but I should do, but we'll come back to that in a short while. Now, just to give you some background, I've been trading for a long time now, and one thing I do like is my statistical analysis. It forms a significant part of many of my strategies. I like knowing the probability of something happening. It gives me a lot more confidence in taking a trade if I know it's got a 60, 70, 80% chance of happening. That way I feel more confident I can place the trade and leave it and let it do what it's going to do. I don't only use the statistical analysis for getting into the trades, but also exiting the trades. I know there's points in the day where we're probably getting to a point of what I'd refer to as extreme. I'll give you an example, and this one I'll let you share. If we take a daily pivot, you get the pivot point itself. Sorry, it's going to be bad writing because I'm using a mouse here. So you've got the PP, and then you've got R1, R2, and R3. So there we go. And then you've got the S1, S2, and S3. Now, I know statistically there's less than a 5% chance. So it's less than, sorry, it's greater than, let's put it the right way around, less than 5% chance of it closing above the R3 or below the S3. So if I know in terms of that, if price is coming up and I'm looking to push in on that day, it's an intraday, let's assume I'm intraday trading, not swing trading, because that's a different matter, because it could the next day, obviously the pivots will move on the next daily pivots and give room for a continuation of the move. But for any given day, when I'm running, say midday, it's mid-morning, perhaps it's got up towards the R3 and I'm in a trade, there's a good chance it may stop there. And certainly in terms of knowing it will most likely close within that region, it gives me, just as I say, when I know stats like this, I'm using them in my favor. So that's when stats really work for you. Now, a lot of people think that stats are key to their success rate, and what I mean by this, and the big statistic I'm talking about, is the success rate in itself, in terms of if you spoke to some traders, and you unfortunately many of them are telling you the success rate of their next big offering, and yeah, this one has 90%, or whatever it may be. I mean, no, we do have strategies where it's 80%, so I should be a bit careful here. I know strategies at 80%, but people get focused on these big numbers. 70% would probably still make most people feel reasonably comfortable, although realistically we know they don't like losing. So as soon as you start getting towards this area, they're feeling much less comfortable. And if you actually said to someone, well, if I give you a 40% win rate, would you be happy? They're starting to look at you a little bit sideways, and they think they'll move on to and speak to someone else now. So what they forget to ask you is, how much money is it going to make me? And the real success. And I know Charlie's covered the subject in different ways, but I want to show you it from a statistical way, because I came across some statistics that someone forwarded me in our trading room the other day, and I just thought, yep, this is great for Wednesday. So let's have a look. Now, I do a lot of analysis, as I say, and basically you can generally provide yourself with a bit of a badly drawn triangle of the potential success rate relevant to the reward. So how much money am I going to make? The higher the rate, let's say we've got a 90%, well, the reward is smaller. Generally, I get to a point where it may be 70%. It may be, for a strategy, 70% yields the best reward. And how I base that is I look at how many points I can make, and if I can make more points, I'm looking at where can I make the most points. I'm not so worried about the probability. The probability itself is effectively a bit secondary, but I want to know what the probability is, of course. But where can I make the most points? And generally, you get to a point where maybe on some strategies, 40% is okay. It depends on what it is and how it's going. Again, there's reasoning behind that, which I'll come on to shortly. But in some of my short term, I'm talking about short term, not swing trades here, particularly when you start getting down to 40%, then generally in a lot for a lot of my trades and my analysis is you're earning less. You end up with this sort of, as I say, there's a sort of peak profit area, and that's what interests me. Where can I make the most money, and then I'll trade it from that perspective. Although I do know people prefer higher percentage win rates. So the win rate isn't everything; it's the reward that you're getting. Now, okay, I've already gone through this in terms of the backtesting analysis. A lower win rate can give you a better a higher return, and that's what we're really looking for as traders and as businessmen. Is we're looking for returns on our investment. Now, I was given this the other day through another link, which FXCM have released their trading data, which is analysed by their part of their operation, Daily FX. Now, this itself gave me some really nice stats, and I like stats, and I thought I'd share them with you, because by only seeing the stats, sometimes it's what triggers people to do something differently. Some people just realise it's a bit common sense to go one particular way, and they'll listen to that and they'll hear it and they'll go. Other people need to see it, and I'm showing you some stats here, and some of these stats could actually make you think, wow, I need to change drastically in terms of what I'm doing. Or look at what I'm doing, and it may give you, well, the most important thing, it will give you some thinking. I want it to make you more profitable. That's the absolute aim here. So what they came up with, their conclusion was brilliant. On average, traders are good at picking winners. For the euro dollar, they quoted a 61% win rate. So you think everything is hunky dory, wouldn't you? But we know that's not quite the truth. Houston, there is a problem. And it's the next statistic that said it all. The average win rate was just 48 pips relative to the average loss rate of 83 pips. Now, this is quite an interesting rate. I'm just going to pause this a second and give you some. Well, actually, I'm going to show you just an open order book. Okay, sorry, I just paused it. And this is the order book. You can get this on Ezeetrader website. You can just go to resources and order book. And you can see where the open orders are at the time. There's ways of getting a bit more detail out of this. But the important thing, what my point here is, look at this. Okay, this is the open positions at the current time. Now, what you'll see is these are shorts. These are shorts, and these are long. This is the current price. So all the people, I'm going to draw differently down here. Hopefully, all the people down here on the short side are losing money. They're the losers. Anyone down here on the long side are the winners. Now, I often say this in our trading room. Look at all those people that are sitting there with all that pain. Look, some people are still sitting short at 1.5, and it's 600 pips or more differential now, and they're willing to sit through all that pain. So it's that's what they like doing. Yet look at how few relative long positions are from that earlier point, and I think this in itself often says quite a lot. Now, okay, there'll be swing traders and day traders amongst this, and the day traders would come and go off this and probably endure significantly less of the pain side than some of the swing traders may do. But whatever happens, this is really showing you, okay, these people up here are long, and the price is below them, so these are the current ones that are finding the pain here. And even then, look, at 159 they're sitting there long quite happily, 300 pips away from the current price. I say quite happily, I'm sure they're not, and yet these guys that shorted up there's very few of them, and it really does balance out how the book's going. It sort of starts to make sense. Right, let me pause this and get rid of it. Okay, so let's come back to where I was looking at my slides here. So the average win rate win was 48 pips, loss 83 pips. Okay, so if we put this over 100 trades, we've got 61 winners at 48 pips, which would give us 2928. Then losses, we've got 39 losses at 83 pips. It gives us loss of 3,237, netting minus 309 pips. So it's quite a significant loss there. And this is taking possibly for some people the brighter side of things, because there'll be people that sit in the trade and have, much bigger stops. There'll be their wins this is an average 48 pips. Their wins would be a lot less on many occasions. So it may actually picture for some people a much brighter picture in reality. Often what we see happen in these cases is that they'll open a trade, it runs up nicely for them, pulls back to entry, runs it, they leave it a good lump, probably at more than 83 pips, that's an average. It gets back positive and they take the profit. They're not worried about making any money on that part of the trade or that trade. That's it. So a lot of this will be made up of there'll be lots of small wins, and perhaps the average winner may flatter things a little bit more here. So it's not such a great picture. Now, as an obvious thing, the amount risked to the potential reward is completely out of sync here in general. Now, obviously, the winners are going to be making money. They came up with some conclusions from their data. It was clear that you could have a one-to-one risk reward, and this was with real live accounts they were looking at. The people that had a one-to-one risk reward ratio, and they were winning. Some of them were winning over time. There will be some that lose, obviously, but the one thing that's possibly missed out from the data is the fact that what's classed as a win and the average win. There are some traders that their position is going in their favor and they're positive. The price would go below them and they're negative. Price comes back in, they close the position because it's just come positive again. You know what happens next. I'm not going to rub the salt into the wound. Sometimes it does roll over and go down this way. Other times it shoots up and goes to their original target, wherever it may have been. But of course, within those numbers, there'll be people that are doing this. There'll be people that their reward is this much up here, and they'll be letting it go off the chart here, so you can't actually see where I'm going, and then wait until it gets back, and then they're not allowing things to run right at all. So, okay. Some key things here. Higher risk reward ratio will give you more losses and most likely more profit. So it's really a case of changing the mentality in terms of ensuring, and it was good today that one of our traders, I'd given a target area and at my stop. Now I'd just given the target area as a not as a specific level, but as a indicator. Now that indicator was different on his chart to mine. He looked at it and his risk reward didn't fit. For me, it's a high probability of it being hit. I was happy. I was actually looking to make 17 points whilst risking 15. That was the risk reward. It was a tight one. I don't like those so much, of course, but the probability was really good. He didn't take the trade because where he was looking at the indicator on his charts, it was showing only 12. What great! That is where you've got great control and someone actually making a proper decision. I'm not going to take that because the risk reward doesn't fit my rules. And if you can get to a point where you've got higher risk reward, you may have some more losses, but the more important thing that we all want is the profit. We want to be more profitable, and it's just a case you take a few more of these to make more of this. Okay, now I do give some guidance here. Don't fool yourself. Check your analysis and ensure that the risk reward ratio is potentially possible and logical. I see some people, they will say, well actually, yeah, I'm going to run this one for 50 pips, and you can see 4 elements in front of them which potentially will just stop it point blank in terms of serious resistance above where they're looking to go if they're going for long, or vice versa if they're looking at short. Look at what's actually possible and probable. It's not going to be guaranteed, but look at it. Don't just say, well, I'm going to risk 20 and I want to make 80. It's got to be technically possible, effectively, and as I say, logical. There's some logic to the trade, because then you've got a better risk reward. If you're just going to go 80-20 in every trade, then maybe with a throw of a coin you could possibly do it. But in current markets, if you're day trading like this and we're chopping away as we are, you're not going to be doing it. and you're going to take many days of losses. So the best thing here, have a logical area, do your analysis, have a reasonable strategy that you're going to use. You do your analysis, ensure that the potential's there, and then take it. The next point I really want to make here is take the trade, set the stop and the limit orders, and walk away. There's nothing worse, and part of my job is sitting there analysing the markets all day long. Sometimes I really just want to walk away from the screens and not look at them, because you're more tempted to see every point of minute detail and possible support and resistance that may get in your way. When I'm talking earlier on about support and resistance, I'm talking about bigger time frames, not just a little tiny 5 minute and 2 minute eeny-meeny stuff, which may have a reaction, but in the bigger scale of things, it's going to carry on running. I'm talking about the sort of hourly and 4 hourly and daily sort of areas, and the sort of key levels of support. They're the things that you need to be looking at as more solid, but you don't want to be worried about the little stuff. So the best thing is often to walk away. Now I have a thought for you. This is risky. Would you like this? Okay, here it goes. Traders that adhere to the rule in terms of risk and reward, better than 1-to-1, were 3 times more likely to be profitable over 12 months. Here's a risk. Here's a challenge. It's currently the 1st of July 2015. Remind me next year at this time how successful you've been. Put it in your diary. Stick it in there and adhere to these rules that you must have a minimum of 1-to-1, but ideally 2-to-1 reward to risk. People call it risk reward. I'm sure it's the wrong way around, because the brain gets confused, and they risk 2 and only make 1 reward, and that's what's been happening here. So I think you need to get it reward and risk 2-to-1, 2 reward to 1 risk. Be aiming for as much as possible, and walk away, place the orders, make sure your stop's there, don't move the stop unless there's an absolutely essential reason why a stop should be moved. They shouldn't be moved, and the only way they should be moved is upwards. You can reduce the risk, remember, as prices and as things move in your direction. So you can actually improve your probability of winning by maintaining the trade. But at the end of the day, what I'd like you to do, as I say, is go away, use this, ensure that you're sticking to it, and let's see if our clients and our listeners actually make a significant difference over the next 12 months. That's it from me. There's no I'm not going to go through the markets. I do that every morning. You can find it on the website under the blog. So have a great one. Bye for now.